bias, and I'm gonna consider M15 for rules and entries, right? So I'm gonna consider M15 for rules and entry. Now, I'm not saying that other time frames like monthly, H4 are not important, but because of my style of trading, I'm just gonna consider these two. Well, I do apply the H4 so that I can know like in which of the cycle are we, in which order flow are we, like are we in a bullish order flow, are we in a bearish order flow. Though these order flow concepts, I don't normally apply them that much when I'm looking into VIX more than when I'm looking into PES. So I'm gonna look for my bias on an H1, then I'm looking for the rules on an entry. Then I consider the TDI. Like the TDI is the game when you want to understand the spiking rules. Like the TDI is the war game. That's why I like when it comes to boom and crash, like I get overconfident. So let's quickly jump into the charts and let's get into it. So I'll open a chart of crash. Do I want crash 500? Yes, let's look into it. And I'm gonna open like my H1 chart. So the rules remain constant. Like the rules, guys, the rules remain constant. So what you wanna do, the first thing is consider the trend, consider the flow, consider the level, consider, I don't know what you wanna call it, whether you wanna call it like the order flow, you wanna call it the trend, you wanna call it, I don't know, the cycle, but look at the direction of the market. Is it bullish or is it bearish? Like for example, I have a great case right here where it's bearish, right? So it's flowing to the downside. Now there are many ways, various ways, I can't say many, but there are various, like a number of ways in which you can use to like identify the trend. But one of the easiest method that you can use is always considering like the order blocks. As you can see right here, I have a series of bearish order blocks all the way, which means this is a bearish order flow, and I'm going to be considering bearish bias or selling activities more than I'm looking into buying activities. And since this is crash 500, right, crash always spikes to the downside, boom always spikes to the upside. So crash 500 in a bearish momentum is a beautiful thing that I always want to consider. So if crash is in a bearish direction, then great, time for me to look for my direction and time for me to jump into the 15-minute time frame so that I can consider now. If you look into the previous video when I taught about these BTMM EMAs, right, you're gonna like understand this one better. If you haven't, like, check that video. I'm gonna put like there is an I right there, I don't know, right right there of the video. Then you can just click that up so that you can check that video if you haven't. Well, if you had, let's continue. So you see right here, after detecting the trend, guys, after detecting the trend, as I can see right here, I have a series of bearish order flow. The market always drops and pull back, drops and pull back, drops and pull back, drops and pull back. So what you wanna get, right, is for each pullback that hits the 50 EMA, each pullback that hits the 50 EMA, when price hits the 50 EMA on an H1 time frame, you've guessed it, guys, it means it's a peak reset on an M15 time frame. It means it is actually performing an M, pardon that, an M on a 200 EMA on a 15-minute time frame. Let me say that any better. If price hits 50 EMA, if price hits 50 EMA on an H1 time frame, if it keeps on hitting on a 15 EMA, 50 EMA on an H1 time frame, this means that it's gonna be bouncing on a 200 EMA on a 15 time frame. When price does a beautiful M on a 200 EMA, that's a beautiful reset, and we are looking forward for a great reversal, a great continuation in terms of that trend. Now, I even tried here, I've detected my flow, and it's actually bearish, and it's exactly what I want, and I see pullbacks, right? So we're gonna look at this zone, we're gonna look into this zone, and we're gonna pay attention to these two zones or these three zones right there. So on a 15-minute time frame, what we are looking for is usual, we want to see a beautiful, nicely formed M on a 200 EMA on a 15-minute time frame. But this time around, the only difference when we're looking into boom is we always consider the TDI, right? We always consider the TDI. Now look at it, guys. For each zone that I placed the yellow box, which was a bounce on a 50 EMA on a lower time, on a higher time frame, is actually a beautiful hit on a 200 EMA. The very first things that I just want to show is a beautiful hit, a beautiful hit, a beautiful hit right on a 200 EMA. You see these three bounces right there, and I'm telling you, I picked this straight up, I picked this straight up. Now, the TDI comes into play. What you want to see on the TDI are two things. There are two important things that the TDI always shows. Wow, the TDI shows a lot of things. It shows volume, it shows the end of stop hand, and a lot of stuff, but we're not concerned with all that. We're just concerned with two key factors that the TDI is to show. Number one, we want to look at what we call the shark fin. Now, if you don't know what the shark fin is, the shark fin is when we have these Bollinger Bands in the TDI, and they're normally called, I don't know, the water, I don't know. These are just funny names that people give. Then we have the RSI, normally it's green, and when it comes, it jumps out and it comes back, forming something like a fin of a shark. Or when the RSI jumps out of the volatility bands, this is what we refer to as a shark fin. Now, if you don't know what a divergence is, or factor number two that we look at in the TDI is what we refer to as the divergence. Now, divergence is when we have our TDI right there, and our TDI performs something like this, and we have our price right there. Price, let me mark it in some other color, and we have it something like this. So what do we see right here? Great. What do we see right here? We have price going to the upside direction, and we have indicator going to the downside direction. What do I mean? I'm trying to say price is forming a higher low. You see right here we have a higher low, or let's say a low and a higher low. Now we have a lower high, and right here we have a lower high. So this means an imbalance in market volume, right? An imbalance in market volume. So when price and indicator are doing the opposite, or when price and indicator are going the opposite direction, these are what we refer to as divergence. And when the TDI is going and when the RSI goes out of the volatility bands, then come back forming a fin of a shark, this is what we call the shark fin. So on our 15-minute time frame, we want to look for either of the two. Number one, identify the trend on an H1 time frame. Number two, identify a bounce on a 50 EMA time frame. As soon as the price bounces on a 50 EMA, as soon as price bounces on a 50 EMA on an H1 time frame, you are dropping lower so that you can look for the TDI confluence. Now the TDI confluence that we are looking for are either the shark fin or the divergence. Right. Now let's look into it right there. We have price. Let's look at the very first scenario. We have it right there. Price, bounce right there. Right. Where are we? A bounce in 200 EMA. And what do we have? We have the RSI jumping out of the volatility bands, then coming back in. So when you see such kind of reaction, happening, this is a good sign of reversal. And as soon as price closes below the 13 EMA, you are shooting right there. So that's why we could have taken our very first sell right then, drop. The spikes begins, and you know that this is a 15-minute time frame, right? I'm not talking about M1 spikes whereby you just catch one spike, and no, I'm not talking about that. I'm talking about like beautiful intraday trades. We have it right there. Again, same setups, right? If you look at this portion of price and this portion of price, you can see like some identity, like something identical when it comes to price action. We look at it right there. We have indicator jumping out and coming back in. Beautiful. And as soon as that happens, price bounce on a 2 EMA, on a 200 EMA, shark fin, we have it right there. When you see such kind of reaction, whenever you see such kind of reaction, right, as soon as price closes below the 13 EMA, wow, there was a little bit of some drawback, or I can call it like some delay, consolidated, but the spikes begins. If you look at this portion of price and this portion of price, there is something similar about it, but just that this time we don't have divergence. We don't have shark fin. We have divergence. Now, what is divergence? When price is to the downside right there, and indicator to the upside right there. So when this happens, this is also a sign of reversal. So considering the conditions, number one, an H1 bounce and 50 EMA. Number two, a 200 EMA bounce on a 15-minute time frame. Right. TDI confluence, in this case we have divergence as soon as price closes below the 13 EMA after divergence, right? Or as soon as price closes down the 13 EMA, closes down the 13 EMA just after divergence, we shoot it, right? We sell it right there, and boom, the spikes begin. Guys, if you look at this portion of price action and this portion of price action, well, this one was a little bit tricky because it didn't actually happen the way we wanted, but I still caught it